Hey everyone, my name's Andy. My channel's Finding Value. This presentation is about positioning. And positioning is dependent upon certain things and how you want to position your portfolio to take advantage of certain market conditions. So I've got basically the real estate cycle and potential investments that you could partake in given a certain spot in the real estate cycle. Because real estate really determines if you have really neutral inflation, high inflation, or deflation. So I'm going to get into it and show you what my opinion is on positioning given certain market conditions. So this is called positioning. So investing is positioning for the future. So investing is about looking into the future and positioning for it. You need to look at multiple things. You need to look at market conditions, which include interest rates, inflation, and really it's the real estate cycle. Then you want to look at market balances of materials, and you may invest in certain sectors over others given the market balances of materials. If there's deficits in the future, if it's uranium where you've got a lot of deficits out there 5-10 years out, you might position differently knowing what the market balances are and the forecasts of those market balances in the future. And then after you take this all into consideration, the market conditions, the market balances, and all this stuff, you want to invest accordingly to those conditions. So next I have is the real estate cycle. The cycle is 4 quadrants. It's recovery, expansion, hypersupply, and recession. And I wrote in here, kind of in black, what I think might be good investments to take into consideration for those areas. So during a recovery phase, you're going to have low inflation, and typically what they're going to do is they're going to lower interest rates from the previous hypersupply phase. So when you go to hypersupply recession, they're going to be lowering rates. It'll kind of all crash out, and what you're left with is you've got the housing market in a recovery phase. So in that phase, usually you have low interest rates and low inflation because the housing market is recovering. This is typically when stocks do extremely well. This is a risk on play because the interest rates have already bottomed and things are coming back. So stocks do particularly well in this area. We've been in a recovery phase in real estate, I would say all the way back to 2008, 2009. We've been in a recovery phase, and we're just starting to go into an expansion phase of real estate. So in that type of environment, the recovery phase, stocks would do exceptionally well, and we've seen that. In an expansion phase, what happens is inflation starts to kick up, and typically interest rates they raise interest rates over time during the expansion phase because you have inflation. They want to slow that inflation down, and people are selling bonds, so interest rates have to go up in order to equal and clear all of the markets. In this sector, typically what's the best to invest in are commodities or inflation-protected assets like precious metals. So that's kind of the phase that we're entering now, and those commodity type investments or inflation-protected or TIPS or whatever your preferred investment vehicle is good to invest in because of the inflation. At some point in the future, we'll enter a hypersupply phase where they produce too many homes. They've gotten a lot more strict on producing homes, so perhaps this cycle isn't as large as last cycle. But typically, if you have a hypersupply phase, the best thing to kind of jump into right during the top is to get into bonds. It'll be high interest rates, so you're going to be getting a lot of interest on your bonds. And when the stock market crashes, which it'll be the stock market and the real estate market, everything will crash because it's deflationary, bonds will go up in value as they pay the high yield that you've locked in. And when they lower interest rates, those bonds will go up in price. So in the hypersupply recession phase, on the right-hand side, you want to position in bonds during the hypersupply phase where you reap the rewards in the recession. Now, in the recession, they're going to be lowering interest rates. Most everything kind of crashes out. They're going to have to reflate everything because everything deflated. And you'll see in that cycle, the recession, during that recession, bonds will do very well. And at the bottom of the recession, as it comes up into a recovery phase, that's when you want to load up on stocks on the bottom of that recession. So that's the real estate cycle. So most understand real estate cycle. The real estate cycle determines a lot of where we should be investing. Each asset does well depending on where we are at in the real estate cycle, because that cycle has an effect on interest rates, and interest rates has an effect on how assets are priced. That's really the whole gist of all of this. Demographics also drives a lot of the long-term movements. That's long-term interest rates and growth for a country. If you don't have growth in demographics, you don't really have much growth in terms of real estate, real estate going up in prices and inflation from real estate. So you have deflation if you have a declining population. And you look at demographics of a country to see if they are worth investing in. So if you want to invest in a country, what you look at is you look at their real estate. You look at real estate there. You look at the demographics. And then if they have a very large population growth and their real estate's going up, more than likely that's probably a good place to invest. Maybe perhaps India might be a good spot to invest in right now. And emerging markets, since we have a commodities boom. Emerging markets will do exceptionally well. So getting it right. Once you figure this out, money will come to you nonstop. You can kind of just rotate between assets and benefit knowing where you are in the real estate cycle. You won't need to diversify as broadly across. You're going to be more focused on what works. You can get outsized returns during any market cycle if you know where you're at in the real estate cycle. Real estate ties it all together. And I don't think a lot of people have really figured this out. I don't really hear a lot of people talk about this. Most finance guys are stuck in finance. Most real estate in real estate. There isn't really much crossover or tie over. So the conclusion here is you need to watch real estate. Whether you like it or not, you're going to have to watch it. This allows you to position investments into the best areas depending on the cycle. And investing becomes much easier after you realize this. And I know this isn't an all-inclusive thing, because obviously you're going to have to be looking at your value for certain market sectors. Right now we're coming off of a recovery phase for real estate. We look at our ratios and we notice that, hey, uranium's dirt cheap, oil's dirt cheap, natural gas is dirt cheap. A lot of the metals are dirt cheap in relationship to gold. Gold goes down in a recession and a recovery phase. It doesn't go too much in the beginning, but it does start, notching upward at the end of the recovery phase before the expansion phase. And that's what we're seeing in the markets right now. If you look at all of the data that we have out there, all of it, it all ties together when looking at it through this paradigm that I just showed you, through the real estate cycle. The recovery phase since 2009, 2010, all the way to about 2016. We were supposed to be entering an expansion phase, and it's been kind of delayed. It's been going very slow in terms of new housing starts. We're starting to see house prices really take off. We're starting to see new home starts take off. And we're supposedly, if they weren't manipulating interest rates, would see interest rates take off. So that's what we would see in this cycle if it was a free market, do whatever you want cycle. But they can't afford higher interest rates, so they're going to do QE to suppress the rates down. Now, if they're successful at suppressing the rates down, you're going to see higher rates of inflation, and you're going to see larger and larger real negative rates. The effect of real negative rates is going to be absolute fire under commodities and precious metals. So I think that commodities are an exceptional bet because, one, if you value them any which way from a ratio perspective, they are extremely cheap in relationship to gold, and gold is extremely cheap in relationship to stocks. So we are in the cycle for commodities. They are absolutely have not been this cheap ever, number two. And number three, real estate hasn't been in this bad of an area in terms of inventory and days on the market and all this stuff. We haven't had inventory this low. I don't know if we've ever had it this low. I know it's been at least 40 or 50 years. And I think that's where the data goes back to. So what I'm expecting going forward is very strong inflation, very strong commodity prices. And if we can position correctly in our favorite sectors, looking at market balances out in the future that have good deficits, there is no reason that any of you guys can't retire, much sooner than what you think. So if you guys like making money, subscribe to this channel. If you like this content, give me a thumbs up and join this community, and let's kill it for this next commodity cycle. Thanks for listening. This is Finding Value.